Good afternoon. I think it's afternoon now. I'm Charlie Edgerton. I will be joined today by Steve Lee over there and Steve Looney. All of us are tax partners. We will be covering the impact of recent changes in the tax laws on real estate. And the idea for this particular program arose because we have within our firm industry groups where we bring, it's kind of an interdisciplinary thing where we'll bring different attorneys from different specialties who service a particular type of client who's involved in a particular industry. And we had a real estate industry meeting right after the first of the year. And Steve and I were pointing out the recent tax changes and talking about the impact of real estate. And the real estate attorneys and the finance attorneys who were present wanted us to elaborate a little bit more. And we thought, what a great idea. We can invite our clients and our friends in the profession to come and share with them some insights that we have, nothing that probably you haven't heard. But all of these changes come from really two primary sources. One is the American Taxpayer Relief Act of 2012. And when we finish this seminar, I think you will wonder where in the world did they come up with that name. And we're also going to factor in changes under the Affordable Care Act, the Obamacare Act, which may surprise you because that was passed in 2010. But this year, we have the first major tax impact from that. We're going to talk about that today, and it has a definite effect on real estate, and it's something that you need to get familiar with and get used to dealing with because it's going to impact most of what all of you do. I'd also like to ask all of our Dean Mead attorneys who are present just to stand, if you will. We have a good representative showing, and a lot of these folks are real estate. We've got some tax attorneys in the midst, and we thank you all for coming as well. Without any further ado, I'm going to turn this over to Steve Looney, who's going to introduce the first part of this program. And by the way, just for your information, this program is being taped. If you want to see it again, if it's that good, it'll be on our website in about a week, and it will be available to you. We also were informed that one member of the press would be present, but I don't think she has shown up yet. So thank you again for coming.
Thank you, Charlie. I think the other point of it being videotaped is to be careful with whatever questions you might want to ask because it is going to be memorialized. Charlie took a little bit of my thunder. As he said, we're primarily focusing on the taxpayer, the American Taxpayer Relief Act of 2012. And I was going to say, too, it may provide some relief, but on the other hand, it provides a lot of burdens for other taxpayers. Also, we will be looking at the Affordable Care Act, and principally our focus, there's a lot of changes and extenders that were made in the Taxpayer Relief Act. We're going to be primarily focusing on the changes made in rates, because that was one of the most hotly debated issues, particularly the maximum marginal income tax rate applicable to so-called higher income or wealthy individuals. And we'll see how that was defined in the act, so to speak. We're also going to look at, of course, a lot of debate was what would the rate be on capital gains, what would the tax rate be on dividends. And as far as the Affordable Care Act, what we're going to be looking at is the increase in the hospital insurance or Medicare portion of the FICA tax and the self-employment tax. That's from the 0.9% increase as a result of the Affordable Care Act, and also the substantial effect that the new 3.8% tax on net investment income that Steve will be discussing in a few minutes will have on real estate decisions. And as Charlie said, we are focusing on how these tax changes impact real estate, but these tax changes, particularly the rate changes, have a far wider reach here and really affect all types of businesses and business decisions, including choice of entity in many cases. With that, I'm going to go ahead and start. And Steve, we'll go to the first slide. As you all know, the maximum marginal tax rate applicable to individuals as a result of the 2012 Act increased from 35% to 39.6% with respect to individuals having taxable income of more than $400,000, and with respect to married taxpayers filing joint returns having taxable income of more than $450,000. And that's basically what that points out. There was much debate. President Obama and the Democrats really started out with they wanted to use the same threshold they used for the net investment tax, and that was the $200,000, $250,000 threshold. I think a lot of the Republicans wanted to go to over $1 million, and I think Biden stepped in, and this is where we ended up. And if you'll go to the next slide, this is kind of the new revised tax rate table. And again, not much has changed except for the new 39.6% bracket for those making over $400,000 or $450,000. As far as the capital gains rate goes, as you know, the so-called Bush tax cuts were set to sunset, and they got extended a couple times, but absent any changes, the tax on capital gains was going to go to 15 to 20%, and more significantly, the tax on dividends was going to go from 15% to the top marginal rate for individuals, and which would have been 39.6%. As a result of the 2012 Act, we now have a maximum marginal rate on capital gains and dividends of 20%. Again, for those individuals having taxable income of over $400,000 and married couples filing joint returns of over $450,000. And Steve, if you'll go back a second to the table, those first two brackets, if you fall within those income brackets, you actually will continue to pay 0% capital gain rate. And in between those brackets and the 39.6 bracket, the 15% dividend and capital gain rate that was previously in effect will continue to apply. Now, those were some of the most discussed and publicized changes. However, there are a number of other changes in the Taxpayer Relief Act of 2012 that certainly have the effect of increasing the effective tax rate on taxpayers. And because these weren't publicized as much, we refer to these as stealth taxes. First of all, you have the so-called phase-out of itemized deductions. And that has different thresholds than the 39.6% tax rate. Basically, the phase-out of itemized deductions applies to taxpayers whose adjusted gross income is greater than $250,000 for individuals and greater than $300,000 for married couples filing joint returns. And what happens is your itemized deductions are reduced by 3% of the amount by which your AGI exceeds those threshold amounts. And your itemized deductions can't be completely wiped out, but they can almost be completely wiped out because they can eliminate up to 80% of the itemized deductions under this so-called phase-out. The other phase-out that was reinstated, that was around before the Bush tax cuts, is the phase-out of the personal exemption. And again, this applies to taxpayers having adjusted gross income of over $250,000 or $300,000. And those exemption amounts are reduced by 2% for each $2,500 of income over or AGI over the threshold amount. Now again, the effect of this is you really have higher effective tax rates on taxpayers making less than this publicized $400,000 and $450,000 figure.
Steve,
And
I think if I remember it correctly, that the combined effect, if you get the full brunt, could raise the marginal tax rate 1.2%.
Okay, so another 1.2%. On top of what we'll talk about soon, the 3.8% tax on net investment income. So there's a lot of components here falling into place. Just very briefly, you all know for 2011 and 2012, we had the so-called payroll tax holiday, and that's where the employee's portion of FICA was reduced by 2%. Self-employment tax, the OAS DI type portion was reduced by 2%. Well, that's eliminated for 2013. So all taxpayers are paying increased tax rates as a result of that, along all tax brackets. Additionally, the wage base to which the so-called OASDI portion, the 12.4%, is subject, has been increased for 2013 from $110,100 to $113,700. Again, representing another effective tax increase for taxpayers. The other item I wanted to talk about before I turned it over to Steve was the Affordable Care Act and how it raised the Medicare portion of the FICA tax and the employment tax from 2.9% to 3.8% at the beginning of this year on employee wages in excess of $200,000 for individuals and again $250,000 for married taxpayers filing joint returns. And keep in mind, there is no maximum amount on this 3.8% portion. Another interesting aspect that hasn't been highly publicized is that though most self-employed individuals can deduct 1/2 of their self-employment taxes, if they're paying the additional 0.9% because they're in the higher brackets, none of that is deductible for income tax purposes. So something to keep in mind. And again, so what we're left with is kind of a mishmash as far as when you're talking about what are these so-called wealthy taxpayers or higher income taxpayers. And some for some reasons, it's those making over $400 or $450, others making over $250 or $300, and then finally for the net investment income and the FICA and self-employment tax, it applies to those making over $200 or $250,000. And with that, I think I'll go ahead and turn it over to Steve, who's going to talk a little bit more about that 3.8% tax on net investment income.
Steve's been talking about increases in tax rates that are coming into effect. I want to talk about a new tax, and that's a new additional tax of 3.8% on net investment income. And what you have to realize that this is in addition to the tax rate Steve spoke about, whether it be capital gain or ordinary income rates. This is an additional tax. If it applies, it's in addition to those taxes that we've been talking about. And this tax is on net investment income, and I'm going to refer to the tax that results this 3.8% tax as NII tax or net investment income tax, okay? The tax, if it applies, is in addition to the regular tax, and it also applies to estates and trusts. Yeah. Makes it a little harder to get out of this tax by shifting the income producing property to a trust for the children. So realize that it does apply to estates and trusts, and they have their own income thresholds as well, okay?
And Steve, just to point out, that as I said, the income threshold for the net investment income tax is the $200 and $250 for married taxpayers, but the trust and estate rates kick in at a threshold of only $11,950. So it's very significant. It's very easy to be subject to the 3.8% tax in the case of an estate or trust.
And it cuts out that obvious plan of saying, let's put it in a trust for the kids and they'll be at a lower income tax bracket or it won't apply, okay? The net investment income tax does not apply to S corporations, partnerships, LLCs. However, those pass-through entities need to file and include on the shareholder or the member's K-1 for the year that shareholder or member's share of the income items that would be potentially net investment income. So there is a reporting requirement that is imposed on the pass-through entities for the net investment income items. The net investment income tax doesn't apply across the board. It's not a straight 3.8% tax, but it is a tax on the lesser of either your net investment income, and we'll talk about what that is, or your modified gross income above the income thresholds, okay? 250, basically, okay? So it's the lesser of those two amounts. So part of the planning may well be if there's a year in which you are going to have net investment income, you want that to coincide when you otherwise have income that may not get you above the threshold, okay? Before getting into what is net investment income, let me go over an exception, because the exception you have to understand in order to realize how to determine what's net investment income. The exception is one that basically I called it the active business exception in the outline here. If income is incurred in a trade or business, in the ordinary course of a trade or business, and the taxpayer is active, not passive with respect to that, then it meets the exception and will not be net investment income. So if you realize that exception is hard to get, it has to be income that's incurred in the active trade or business, and the taxpayer has to be active in that trade or business. If you meet both of those, you fit in the exception and you can get out of the net investment income tax, but that's easier said than done.
And again, just very briefly, there is one exception to the exception. There's what the profession of trading in financial instruments and commodities, and they don't care in that case if it's an active business, you're still going to be subject to the 3.8% tax. For some reason, they deem that to be a bad profession.
Okay, what is net investment income? Net investment income, I've categorized into three categories: portfolio income, other business income, and net gains. Okay, again, it's this type of income provided it does not meet the exception that I mentioned, the active trade or business exception. Okay, the first item of income, portfolio income. That's gross income from interest, dividends, annuities, royalties, and rents. And for purposes of this discussion, rents should come out at you because we're talking about real estate. So net investment income starts off with income from rents, okay? The second category is other business income, and it's other business income from a trade or business in which the taxpayer is passive. In other words, even if you have business income that doesn't look like investment income, if you, the taxpayer, are not active as to that business, then it's going to be considered investment income to you, okay? The third category is net gains. The third category of what is net investment income. Net gains are the gains realized from the sale or any other disposition of property. And for purposes of this seminar, it's the sale or disposition of real estate. So the gain on the sale of real estate is going to be subject to the 3.8% tax, provided you're above the income threshold, unless you meet the active business exception that I mentioned earlier. So that's a big item. You sell a piece of property for $1 million gain, and you've got an additional 3.8% tax on it if you're above the threshold and you don't otherwise meet the active business exception. Okay, I want to ask Charlie was going to point out a couple things on the active business exception as it applies to real estate professionals.
Well, let me, the explanation I'm going to give will mean probably a little bit more to those who are CPAs and other tax professionals, but this whole concept of net investment income is built on a framework that's been in the code since 1986, and that is Section 469, which deals with passive activities. That's what Congress put in the code in order to deal with so-called tax shelters as they existed in 1986. And if you're involved in a trade or business and you don't actively, or as the term is in the code, materially participate, then if you have any losses from that particular activity, you cannot take those losses over and offset income from other sources unless they happen to be passive activities as well. So this is the framework it's built on, but it's not absolutely identical. And one of the things Steve mentioned, that rents are treated as investment income, and they are passive income, and rent is per se passive income. But the real estate industry lobbied Congress, and this goes back, I think, 8 or 9 years ago. And they got an exception, a very narrow one, but they got an exception into the code. It's found in Section 469C7. And it's what we call the real estate professional exception. If you can show that the taxpayer, and this test has to be met each and every year, that more than 50% of the services rendered, personal services rendered by that taxpayer, were in the real estate related income or real estate related fields. and if you have more than 750 hours of services in those particular activities together, and only one spouse can satisfy this, you can't pool the two of them, then you become a real estate professional. Well, what's the consequence of that? A couple of things. One is that rent is not per se passive. It's examined separately. If you can show that you materially participated more than 500 hours in a year, or there's 7 tests actually, you can meet the alternative test a little easier than the 500 sometimes, in the particular activity, then you can remove it from that passive basket. And the question is, to what extent is this real estate professional concept carried over into this net investment income framework? And the answer is, we're not totally sure. The proposed regulations that came out really don't address this to any degree. For example, one of the things that you can do if you qualify as a real estate professional is you can elect to group all of your rental activities, and you can test for material participation on all these things combined, which makes it a whole lot easier to meet it. But if you do that grouping, what happens if you happen to have a particular property, a rental property, and it's triple net leased to a single tenant for 10 years? Now, you could probably slide that one through if you've grouped and you have a lot of activity with respect to the rest of the properties. But here, the question is, okay, is that an active trade or business? And even though you may have grouped it, I suspect the answer that you're going to get from the IRS when they get around to it is no. This is not an active trade or business. I don't care if you grouped it or not. That's for material participation. We don't care about material participation per se. We want to look at this activity. And if there's no real activity, no service activity attached to it, we think, just from informal conversations with some of the folks in the national office, that it's still going to be, that rent's still going to be treated as net investment income. So stay tuned, watch that issue. If you've got people in that particular situation, I think more guidance will come.
What Charlie was discussing is highlights the issue that in order to avoid the 3.8% tax, you have to either be under the threshold or it has to be an active trade or business, and there has to be material participation. So you've really got 2 issues there. Can you go back one screen, Steve? I want to say a few more words about the net gains. The term is net gains, and so the issue being, if you have gains from one property and a loss from another property, can you net the two? And the answer is yes, but if it results in a net loss, you cannot use that net loss to then offset other items of net investment income, okay? I think the other point here would be, it refers to net gains, it doesn't refer to net capital gains. You could have a gain on the sale of a property that ends up being characterized as short-term gain, or ends up being characterized as ordinary income because of depreciation recapture potentially. So the 3.8% tax can potentially apply to increase the ordinary income rate in that situation as well. It's the total gain, if you will. I want to go over a few examples now that are in the outline as well. And the first one deals with rentals. And what these examples are intended to do is to show what the categories are, as well as how broad it is and how difficult it is to meet the exception of trade or business as well as active participation. Okay, the first example we have, the taxpayer is a member of a limited liability company, and that limited liability company owns several commercial buildings, and the commercial buildings provide lots of services for their tenants, whether they have a restaurant, they have security, they do lots of services. And the particular taxpayer is the manager of the LLC and spends his whole day doing it. What I've tried to do is to find one example where maybe the active trade or business of rental will get us out of the net investment income tax. Because here it appears that we have an active trade or business of rental, and it appears we have material participation, and we have an active individual shareholder of that limited liability, member of that limited liability company. And so the result being that as to that member, it should not be, his share of the income should not be subject to net investment income tax. The flip side of that is if there is a passive member of this same LLC who lives out of state, doesn't do anything, clearly not actively participating, even though it's a trade or business of rental in this example, if the taxpayer is a member who is not materially participating himself, then it's going to be net investment income as to that passive member, okay? Second example dealing with rents is the flip side of this. And in this example, we have a doctor who has a full-time medical practice, let's say, and is the sole member of a limited liability company, and it only owns one commercial piece of one rental property, and it's leased to one tenant on a triple net basis, and no services provided. Doesn't appear that it's an active trade or business because it was a net rental with no services. And for another reason, the doctor wasn't participating either, so it doesn't appear that that part is met. So the income that the doctor receives from this rental activity should be subject to the net investment income tax, again, provided he's above the income threshold. Okay? Third example sort of shows what they were really getting at in this law was to say, let's put a 3.8% tax on somebody's investment income, okay? And what I have in example 3 is an operating business. What we have is a taxpayer was a shareholder of an S corporation. The S corporation ran a hardware store. And we're going to say that this shareholder spent his full time running the hardware store, worked full time in that hardware store. This is another example where it seems to be an active trade or business, and he seems to have materially participated, so his share of the income should not be subject to net investment income tax. If, however, again, there's another shareholder who's passive, even though this is an active business, his share of the income from the hardware store, if he's passive, would be subject to net investment income tax. The feeling being that as to the passive shareholder, the income he gets is really investment income because it wasn't something he was materially participating in. Okay? The next example shows disposition of the real property. What we're going to get at is what happens when we sell the real property. And in this example, this is the same doctor who had the one piece of rental property that he leased on a triple net basis. It didn't constitute a trade or business. And that doctor now wants to sell this one piece of real estate. The gain on the sale of that real estate will be subject to net investment income tax, the 3.8%, because this was not in a trade or business and the doctor did not materially participate. So whatever the amount of the sale is, that's going to be subject to net investment income tax, again, assuming he's over the income threshold. Next example was, again, sale of real property, but in this example, I'm going back to the situation where we had a limited liability company that was operating several commercial properties as a trade or business, and it decides to sell all of its trade or business property, real property. Again, if the taxpayer involved, if the shareholder of the member of the LLC had actively participated, the gain on the sale of the real estate that flows through to him would not be subject to net investment income tax. The flip side, which is really the point, is that if you have this active trade or business and it sells real property at a significant gain, if one of the members of the limited liability company was a passive member, that member is going to have net investment income tax to pay on his share of the gain from the sale of these real properties. Okay? That's the key. A couple of things that should probably be taken away from this dealing with the net investment income tax, and that is how can we get out of this 3.8% tax other than retiring and not being over the income threshold? One is to realize that the tax applies to gains that are actually recognized and a part of your taxable income. So if you can make it gain that is not recognized for regular income tax purposes, it also will not be recognized for the net investment income tax. And the first example would be a like-kind exchange. To the extent you can, and we'll talk about this a little bit later, to the extent you are involved in a like-kind exchange and swap properties for properties, even if gain would otherwise have been realized, the gain that is in the property that you disposed of might be deferred or not recognized as a like-kind exchange. If that's the case, then the gain that is not recognized would not be subject to net investment income tax. And so the thought can be, it can defer not only, a like-kind exchange can defer not only regular tax, it can defer the net investment income tax to a later year as well. Okay?
Steve, can I make a quick point and kind of put a damper on this conference? But like-kind exchanges have been with us since, I think, 2 years after the enactment of the original income tax. It's been part of the code even before there was a code, just part of the revenue acts. As you know, there are a number of members of Congress right now who are looking to find ways, ostensibly to accomplish tax reform, but basically to find ways to raise additional tax revenue. And they're looking for loopholes. And there have been a series of articles that have appeared in the New York Times over the past 2 months. And they have identified tax-free exchanges as a major tax giveaway. And many of the authors have suggested that perhaps that's something that should be eliminated. I'm not telling you that it is going to be, but when something gets published in the New York Times multiple times in the front sections in connection with looking for likely sources of tax revenue, that is an item to be concerned about. There is a huge industry that would fight that tooth and nail, and I'm hopeful that that never comes to pass, but it's something that you need to be aware of.
So if you had appreciated real estate that, let's say, was vacant and you wanted to convert that into commercial real estate in a like-kind exchange, you might do it this year rather than wait till next year.
Before they can act. If you have a choice and timing, it might be a good time if you want to do a 1031 just as a safeguard.
And just let me make also a point with respect to like-kind exchanges. I mean, traditionally, like-kind exchanges have been used, and they're very beneficial to defer gain. However, historically, the 15% capital gain rate as well as the 20% capital gain rates are very low capital gains rates. And with the need for income, when you make that decision to defer the gain, you need to think, well, gee, is that capital gain rate, even though these are, quote, permanent changes, they're permanent so long as Congress says they're permanent and doesn't change the law, it might be a better decision to recognize the gain at the 20% or 15% rate than to actually defer the gain. It's something to take into consideration anytime you have a transaction. Now, that's not a consideration when you have a C corporation, obviously. They don't have a special capital gain rate, so they would be paying tax at 35%.
And a C corporation can't die. An individual who's in for the ultimate tax planning will do 1031s until they die, and their heirs can get the step up in basis. And don't forget that. It becomes a permanent deferral.
That's correct.
Steve's point is a good one, and it was the reason that we didn't see as many like-kind exchanges last year as people anticipated that rates were going to go up this year, so they sold property last year as opposed to doing an exchange and rolling a gain into a future year that may be a higher rate. But that's the point, is that like-kind exchanges, unless you do what Charlie does, hold it till you die, the like-kind exchange is a deferral of tax, and it can be a higher rate if you wait too long and the rates go up. Okay? What we were talking about was what unrecognized, what gains that are realized might not be recognized for purposes of net investment income tax. And another one is if you sell your personal residence, there is a exclusion under Section 121 of the code for up to $500,000 of the gain. That excluded gain, since it's excluded for regular tax purposes, is also excluded for purposes of net investment income tax. Realize that even if you have a personal second home, that doesn't qualify for your excluded gain, so it may well be subject to net investment income tax if the other issues are met. Another possible planning tool would be installment sales. Installment sales have always been around as far as deferring the gain from the sale of real property. They should be available as well to defer the net investment income tax, because the net investment income tax would only apply to the gain recognized in a particular year. Steve's point about rates going up is always a good one on installment sales, though, too. If you otherwise could sell something for a very good rate now, and you do an installment sale, the installment sale payments in the future year may well be at a higher rate than they are now. Okay? I think the point to take away on the net investment income tax is to realize that this is an additional tax certainly this is no taxpayer relief. This is an additional tax, and real estate is probably the most hit of any of the examples you can see. It's very difficult with real estate to avoid the net investment income tax. The primary focus is probably going to be not only on material participation, which we're all familiar with, but whether the real estate activity, the rental activity, is a trade or business. That's probably what is going to be most of the discussion in the future. Okay? And I think with that, I'm going to turn it back over to Steve.
Okay. The next example that Steve has in the outline dealing with the net investment income tax deals with a very common situation that you see in all types of businesses. Here we have, in the example, we have a medical practice operated, let's say, by a couple of doctors, and they also want to buy some property on which they'll, run their practice. So they form a separate entity for liability protection purposes primarily, and usually that would be a pass-through entity, usually an LLC, and then they have their related entity lease that property to their operating entity, the medical practice. Well, the issue here is, well, if you're generating income on the rental that comes through, I suppose if you have a big mortgage, you may not have a lot, if you're paying a lot of interest and so forth, but at some point you're going to have income produced by that entity that's leasing the real estate. And the question is that income going to be subject to this tax on net investment income? Well, in the 469 rules that Charlie talked about, the passive activity loss rules, there is a special rule for what they call self-charge rentals. That is, if you have a couple of guys who are in a business, they're materially participating, and all they've done is create another entity to lease that property over to their active trader business, then they're not going to deem that income to be passive income. It's going to be deemed non-passive income under this special rule. Well, the question is, can you use that special rule to avoid the tax on net investment income? And although there's a lot of debate on that, I just yesterday, as I told Charlie and Steve, I called up David Kirk, who's with the IRS National Office. He's the principal author of the regulations on net investment income. And Steve and I saw him at a presentation here in January or February, and he was very clear again that, well, gee, you could, even if that applies, where has that got you in the sense that, okay, it's non-passive, which doesn't necessarily mean you materially participate, but even if you are deemed to materially participate because that rule, you haven't met the trade or business test necessarily. So, and he was pretty adamant about that is the position now. Now, either today or tomorrow they're holding hearings. He said they've got 50 or 60 comments that people have said, well, this rule really needs to apply because everybody structures their real estate holdings like this for asset protection purposes and for flexibility in sales and so forth. But right now, as it stands, that income would be subject to the net investment income tax, and not only that, you have to factor on top of that the fact that you're paying sales tax under Florida state law. So now you're looking at 6%, 3.8, almost 10% tax for the luxury of getting this extra liability protection.
Yeah, I think it's worth stepping back for just a second and focusing on that, because this has been conventional planning. I suspect we have some clients out there that we've advised you to do this in the past.
It was good advice.
And, it may still be good advice. Obviously, the paramount reason for doing this is if we have an active trader business that has a high degree of risk, even though you may have business insurance, and you've got a piece of real estate that's valuable and you want to remove from the grasp of creditors, you set up this brother-sister entity and you lease. And up to now, really the only penalty on that has been the fact that you have to pay sales tax. And you can essentially keep that pretty low. The Department of Revenue, Florida Department of Revenue, really is not sensitive to arm's length charges and what have you. They don't have a concept like we do in the Internal Revenue Code of Section 482, where if you're not dealing at arm's length, the IRS can come in and recast your transaction. But now, a lot has changed. We now have, if you have net investment income on this, not only do you have to pay the normal tax on that, but now you're looking at paying an additional 3.8%. And if it turns out that this is net investment income, and the IRS is looking at this, and you've artificially kept down that rent, guess what? The IRS does have Section 482, and if they think that you're not charging arm's length, they can perhaps increase the amount of rent to a fair arm's length amount, and then impose the 3.8% on top of that. So we got a lot more to think about when we're doing this type of what I call conventional planning now than we did before January 1, 2013.
Yeah, that's exactly correct. And I guess another option for planning, if they don't change this rule, potentially instead of having the brother-sister type corporation, you could have the operating entity at the, well, that doesn't really help you either. You might have to restructure to have a holding company and then have your real estate company as a sub, a disregarded entity, and an operating company as another sub of a holding company. And that way, at least you could have liability isolation without having to worry about the net investment income tax, because they would all be in a single entity in that case. But again, a number of new things, as Charlie said, that you really need to think about. Moving out of the net investment income tax area and really kind of out of the rate changes, there were some other changes made that were fairly significant by the American Taxpayer Relief Act of 2012. And one of those deals with the built-in gains tax that applies to S corporations that were formerly C corporations and have converted. The original rule basically said that if you're a C corporation, subject to double tax, and you convert to S corporation status, we're going to impose this special built-in gains tax. It's like taking a snapshot of your corporation as of the date of conversion. You look at the fair market value of your business as of the date of conversion over your tax basis and your assets. And to that extent, if you dispose of those assets within what they call the 10-year recognition period, we're going to hit you with a corporate level tax just as if you were a C corporation. Well, in recent years, they have given some relief in reducing that built-in gains tax period. They first reduced it to 7 years for certain dispositions, and then most recently in 2010 and 2011, they reduced that recognition period to 5 years. So if you've held the property for 5 years after conversion and you sell it then, after the 5 years, you're not subject to the built-in gains tax. You just have a single level of tax. What the Taxpayer Relief Act of 2012 did was it also extended that rule to 2012 and 2013. But probably even more importantly, it clarified, because there was some debate on this, of what happens if you make a disposition. You've met that 5-year rule. Okay, I dispose of a piece of property in 2013 from my corporation. I've had 5 full calendar years before 2013, so I can dispose of it and not be subject to the built-in gains tax. Well, there was some question, but what if you sell that on the installment sales method and you're collecting payments in later years when potentially the 10-year recognition period has been reinstated and would apply? Well, again, it was a gray area, but in this act, they made it clear that if you make the disposition in a year where you've satisfied the holding period, it doesn't matter that you're going to receive payments over a period of years under the installment sales method. You're completely out of the built-in gains tax. So a very favorable tax provision. And that's also a tax provision we probably won't have time to cover, but in the Representative Camp's proposal, he proposes that the built-in gains tax recognition period be permanently decreased from 10 years to 5 years, which again would be very, very good news for S corporations. With that, I think I'll turn it back to Steve and Charlie.
I just want to make a couple of points so I can let Charlie speak on the dealer issue, which he's going to be talking about. The next two quick points. All I wanted to make, the first point we really already made, and that like-kind exchanges are certainly, as of right now, valuable tools for deferring tax, either deferring it or permanently deferring it. That's that point. The second point was just to point out one other change in the law, and that was to extend a current benefit. Right now, if you have a lender that discharges or reduces your debt. That's what's known as cancellation of debt income, and it's subject to income tax unless certain exceptions apply. One exception that had applied and was going to expire was the cancellation of debt on your principal residence. The Act extended that, so if there is a cancellation of debt that incurs in 2013 on your principal residence, that can meet if it meets the exception, you can not have to recognize the income on that cancellation of debt. That was the only point as to that. And with Charlie, I'll turn that over to you then, Charlie.
Okay. Just one quick point, and this is not in the slides, but it's certainly worth noting. We talked about the Obamacare taxes. We by no means have mentioned all of them. I think all of you are aware that effective January 1, 2014, we have a whole new regime that kicks in, and this is the largest piece of legislation that has been passed by Congress, I think, in my professional lifetime. But there are other taxes, and if you're an applicable large employer, which means if you have an average of over 50 full-time employees, and you don't have and do not intend to offer an affordable care to your full-time employees and their dependents, there is a new tax. It's an excise tax that will apply on a monthly basis starting January 1, 2014. I think everybody has read about that. We may do a seminar on that just by itself. Another thing that just came out, which I think was a total surprise to everybody, and that is, as you know, that insurers now have to accept pre-existing conditions. And in order to finance the transition into that mode, if you will, the Internal Revenue Service and the Department of Health, Education, and Welfare have the power to authorize a special temporary tax. And the tax was just announced. It was on the front page of the Wall Street Journal, I think, a week or two ago. And that is that you're going to pay a premium tax of $63 per full-time employee just in order to maintain your coverage. That was kind of a shock to most people, and if you're a large employer and you have a lot of full-time employees, that's just coming right out of the bottom line. But that's to finance the transition into this new healthcare mode that we're moving into.
How often? $63?
Say that will apply only for 2014, one time per full-time employee, but they have the authority to do it for 2 more years past that. They've indicated that they don't think it's going to be that high, but stay tuned. Who knows? And they say it's only 3 years, but some of these temporary taxes become permanent too. So,
and Charlie, can you give us an idea of so far how many pages of regulations have been issued on Obamacare?
well, according to that same article, 77,000 pages of regulations have been issued thus far on Obamacare. They have a long way to go.
Simplification.
Okay, let's get back to one of the things that we want to focus on next, and that is we talked about the rate changes, capital gains, and the fact that we've gone back actually to the law before the Bush tax cuts in 2001, so we now have a maximum marginal rate of 39.6. And when we talk about real estate, obviously, if you are selling investment property that's treated as it's a capital asset, and you've held that capital asset for in excess of a year, you're paying the minimum rates, 10%, 15%, and if you're over 400 or 450 joint filing returns, 20%, plus perhaps the 3.8% tax on net investment income. But if that property is what we call dealer property held for sale to customers in the ordinary course of a trade or business, then we're looking at perhaps as much as 39.6% marginal rate that's applicable to that gain. Perhaps if it's not involved in an active trade or business, you can tack 3.8% on top of that as well. And the difference between dealer property and investment property, it's an issue that I have dealt with for every single year of my entire career. And there's probably more litigation on this issue than just about any other issue in the code. And we have some slides that basically list the factors the courts look to. There are 3 principal factors. One of those, of the 3, is the frequency and continuity of sales. The amount of activity, development type activity, how much dirt have you turned, how have you done it, That's the second one. And the third one is the degree and nature of your marketing activities. If you have a sales trailer out there on the property and you're selling lots and advertising in the paper and on TV, that's the hallmark of a dealer. But you know, all of us, if we weren't aware of this already, perhaps in theory, became aware of the fact that real estate doesn't always appreciate. Sometimes it depreciates, and sometimes it depreciates really fast, like in 2008, 9, 10, 11, 12, maybe not even 13. At least residential property is going up now. And being a dealer, if you're selling property at a loss, may not be such a bad thing. If you have investment property that you're selling at a loss and it's held for over a year, or even if it's not, if it's short-term capital gain, you can only deduct that against capital gains other than, $3,000 a year against ordinary income. It'd take you forever sometimes on the size of the losses on real estate dispositions to recoup that. On the other hand, if you've got dealer property and you dispose of it, you have an ordinary loss. Now, does that mean you can deduct it automatically? Can we deduct it can we keep it out or use it to shelter other net investment income? Well, first of all, if the taxpayer didn't materially participate in that trade or business, used, he had lieutenants or had brokers or whatever, and all he did was just look at financial statements, in all likelihood, that loss is going to be a passive loss. But if the taxpayer actually was involved, then sometimes it's not so bad being a dealer, and we may have to switch hats and be arguing out the other sides of our mouth that this individual surely is a dealer. He's planning to subdivide this property all the time, and look at everything he's done.
Even though he's done nothing for the last 4 years, he's still planning on subdividing.
That's right. In the back of his mind, and he's got drawings somewhere in his desk to show it. The point there really is that it's kind of a new ballgame when we're looking at dispositions of real estate, and if we're going to have losses, particularly deciding whether do we want to revamp our activities in order to position ourselves if we know it's going to be sold at a loss and it's coming down the road. That doesn't mean that you can just transform things willy-nilly and by putting labels on them. The courts are not that dumb, and neither is the service or the appellate conferees you'd be dealing with. But if the facts are close, there may be planning opportunities that you can take advantage of in order to get into that. A couple of other things that people sometimes don't realize, and that is that if you've got dealer property, and if you do have a gain, now we're going back into what we consider the usual mode, that property is appreciating, and you want to sell, or you are selling this on the installment basis. The problem here is that if you have dealer property with two very narrow exceptions, you can't use installment reporting. All that gain has to be recognized and reported up front. There are a couple of exceptions for timeshares and certain residential lots if you pay a toll charge for the privilege of using installment reporting. Another thing, and this hits C corporations, and there are a couple of publicly held C corporations that were involved in agriculture or timber that convert into kind of land development companies ran into, and the IRS is very sensitive to this, and they're trying to do 1031 exchanges and dispositions of property they've held for 50 to 100 years. So you can imagine the amount of built-in gain that they have with respect to these assets, and they want to do 1031s. And the IRS has been coming in, and this is coming out of the Maitland office of the IRS, so it's something they're aware of, has been saying, well, hey, look at all the stuff. You've gotten all these entitlements. You've actually done some roads and streets and clearing and grading and things like that. You're a dealer in real estate, and therefore you can't do a 1031 exchange. That all has to be recognized right up front. And that issue has been brought up within the last couple of years multiple times. So it affects C corporations, and it affects individuals who are close to the line and want to do 1031 exchanges. So you want to carefully position yourself and as best you can and anticipate the possibility that that issue might be raised if you are close to the line. Okay, who's doing the takeaway points?
Well, I'll start on the takeaway points. The takeaway points in the outline are basically things we've already said. Let me just reiterate what we've said. The first takeaway point is obviously everybody knows there's a spread between ordinary income and capital gain, and the dealer, non-dealer issue is extremely important, particularly when it comes to that spread or when it comes to losses, okay? As I mentioned, the net investment income tax is effectively an increase. Even though it's an additional tax, it's really a tax increase on rental income and on gains from the disposition of real property, okay? A key issue that we're going to probably be seeing a lot on and discussing is what is a trader business of rental. As Steve mentioned, if you have somebody that has an S corporation that's met 5 years of the 10-year rule, now would be a good time to think about selling the S corporation's real property in 2013, okay? Like-kind exchanges still remain viable tools, viable planning tools. And
Yeah, let me go ahead and step in on
let me
this.
just ask it in the form of a question.
All right.
We saw that the rates now for individuals are 39.6%. That's higher than the regular corporate rates. Steve Looney has always loved S corporations and said they're the greatest thing in the world. And the question is, if individual rates are higher than corporate rates, shouldn't everybody have all their businesses in a C corp?
And the answer, of course, is no. They should not. And basically what we have up here is, I mean, the bottom line is, yeah, C corporations have a maximum marginal rate of 35% versus individuals, which any pass-through owner would pay 39.6%.
Plus Florida corporate tax.
Yep, plus Florida corporate tax. That is true. That even equalizes it more on C corporations. But the bottom line is, in most instances, you're going to want to get your money out of the C corporation. And if you do that, you're going to be subject to a double tax. And that double tax, basically under the new tax rates, if you look at doing the top marginal corporate tax rate and the top marginal dividend rate, would be a combined effective marginal rate of 48%. But wait, you also have to factor the 3.8% in, because certainly dividend income is net investment income. So when you factor that in, the double tax on the profits distributed from a C corporation to its shareholders ends up being 50.47%. And that, plus, you haven't taken into account the state level corporate taxes, and then you're comparing that against the 39.6% that owners of pass-through entities will be subject. So the answer I think in every situation, a pass-through entity is going to be preferred to a C corporation.
Now, Steve, I know you're a huge S corporation proponent, but and I'm the partnership guy.
Yeah.
But I think we do agree on one thing, and that is that if you've got an ongoing active trader business as a small business, it's probably simpler and easier to use the S corporation mode. If you've got real estate, and if you have leveraged real estate, on the other hand, generally, we favor using partnerships, and by that I include LLCs, which is the preferred form right now, which is treated as a partnership for tax purposes unless you elect out, because you have a lot more flexibility. You trade complexity, because subchapter K is complex, for flexibility. That's what you're trying to achieve, and you have basis that includes your share of the debt, whereas you don't have that in S corps and so forth. So from that standpoint, we'd probably prefer partnerships or entities taxed as partnerships or treated as partnerships for tax purposes to hold real estate in general.
And I would absolutely agree with that. The one other point I wanted to make on choice of entity, and again, this would be more focused towards other operating type entities, your business, not a real estate business in particular, though, is that an S corporation is particularly attractive when you start looking at the self-employment FICA tax and the new tax on net investment income. For many, many years, there has been authority out there that neither a shareholder's distributive share of the income of an S corporation nor actual dividend distributions from the S corporation to the shareholder are subject to FICA or self-employment taxes. So as long as you pay reasonable compensation to owners who are performing services, you can distribute the profits out as dividend distributions, and you're going to avoid any Social Security taxes, essentially. Add on top of that the fact that if you're materially participating as an owner in your S corporation, that those distributions will not be subject to the net investment income tax. So you're avoiding another 3.8% by using the S corporation. Now you might say, well, wait a second, maybe as an LLC member, I can avoid that 3.8% also because I can show I materially participate. Well, the downside to that is, more likely than not, if you show you materially participate, then you're going to be subject to the self-employment taxes to which a partner of a partnership or a member of a LLC is subject, and that includes the new higher 3.8% tax on the Medicare portion of the self-employment tax. So that's kind of a catch-22. It's kind of hard to argue you meet the material participation test as an LLC member, but yet I'm not subject to the self-employment tax then.
I want to touch on one last thing. I mean, all of you have read constantly that tax reform is being discussed. And I'm talking about comprehensive tax reform. And what are the prospects of that? Well, I'll have to say in our tax group, I'm probably the most optimistic that it will happen. But realistically, it's still very much an uphill climb. But I will tell you, and I'm going to Washington tomorrow to participate in a forum on tax reform and trying to get comprehensive tax reform. But the one thing that gives me hope on this, and Lord knows we need to overhaul this code. It is so far out of date. We have averaged better than one change in the tax code, not regulations, the code, per day for the last 10 years. It is just ridiculous. But the one optimistic point that I would call to your attention is that despite the somewhat reluctance on the part of the administration to embrace comprehensive tax reform, they're all for revenue-raising tax reform, but not necessarily revamping the whole code, is that Chairman Camp of the House Ways and Means Committee, a Republican, has been working on a bipartisan basis with the Democrats, including the ranking Democratic member Levin, on the House Ways and Means. They have turned out a number of papers that have been embraced by both parties and have been complemented by the tax professional groups throughout the country. And Camp has been meeting twice a week with Baucus, who is the chairman of the Senate Finance Committee, and they have been working for 2 years on comprehensive tax reform. And if they get a green light, if they get some encouragement, a whole lot of the work has already been done. And you're not going to get this done if it isn't embraced by the administration. But if somebody can bring them around, it could happen, and it needs to happen, badly needs to happen. For small business, some of the things we just talked about, the last paper that was put out by the House Ways and Committee on a bipartisan basis, recommendations for small business. Revamping perhaps both partnerships and S corporations. In the S corporation arena, it's terrific if they enact all of the stuff that's in there.
Even more favorable changes, yeah.
In the partnership arena, most of it's aimed to stop abuses, but honestly, they're well designed too, and they're needed. So stay tuned. I think there's a reasonable chance it's going to happen. It needs to happen. If it doesn't happen this year, next year's an election year, not going to happen then. But we will wait and see.
Let me just add one thing to that while we're talking about tax reform, because I've seen letters from associations and industry groups lately. You always hear the Camp proposal is great, and it does address small business. But what we've heard about for a number of years is just, the corporations in the U.S. have too high of tax rates. They aren't competitive worldwide. So you've had a focus on reforming or reducing the tax rates for C corporations, which would be accompanied by a reduction in the number of deductions that they could take. The problem with that is, by focusing just on those C corporations, you're excluding the large portion of American business, the small businesses, that do business through pass-through entities, LLCs or S corporations, and you could effectively throw a very heavy burden on those pass-through entities if you keep the high individual rates, only reduce C corp rates, and eliminate deductions across the board for all the entities. So it's really important as folks in business and in practice to be on top of this stuff and to make some waves with Congress, so to speak.
All right. Well, we thank you all for taking the time. We'll actually open it up now here for a few minutes.
And one other thing, if you could fill out, there's a sheet we'd ask you to fill out. If it says anything about technical difficulties, don't put my name by the by the question, okay? But we certainly will take any questions at this time. Yes.
Getting back to the discussion of S corps and LLCs, has there been any change in the liability protection, particularly in the single-member LLC arena? I heard somewhere that some reports have been disregarding single-member LLCs and backing personal assets.
Yeah, I mean, you can add to this, Charlie. I mean, really, there's two types of liability protection when you talk about LLCs. You talk about the protection of the members or shareholders of an S corp or an LLC, protecting them from the liabilities at the business level, protecting their personal assets. That's always been the same, and that hasn't changed. And they're both relatively safe as long as you observe corporate formalities and so forth. The big change that was made was to protect the entity, LLC entity, from the individual liabilities of its members. And this goes back to the charging order protection. There was a decision, what was the big case here in Florida? What is it?
I can't remember.
Oh my gosh, we're drawing a blank. Well, anyway, what was it?
Homesteads.
Olmstead. That came out and basically said single-member LLCs, the creditors are not limited to the charging order remedy. They can go foreclose and go against the assets. Even though it's an individual debt of a member, they can go against the LLC. Well, that applied to an individual LLC, but at the same time, the reasoning they used could have been used to apply to multi-member LLCs in Florida. Long story short, they changed the law. It's clear that multi-member LLCs, the exclusive remedy of a creditor of a member is the charging order remedy. But with respect to a single-member LLC, there are some special rules. And if it's not producing income, so to speak, then the creditor may have the right to go directly against the assets.
I will also point out that the legislature right now is considering legislation that is highly likely to pass that will completely overhaul Chapter 608 dealing with limited liability companies. And we'll probably know a lot more about that within the coming month. So make sure if you use LLCs, have an LLC, that you stay tuned. It's supposed to be an update, a modernization of the law. But that's a general term, and I like to read the specifics before I make my own judgment on these things.
Any other questions?
I actually have one quick comment and a question, but I'm with ICSD Government Relations as a volunteer position, and we are trying to fight against the sales tax on commercial leases in the state of Florida. It is very unlikely to pass as well, but there is some steam ahead with many organizations being involved, so keep your eyes and ears open, and if you have a direct connection with anybody up in Tallahassee, maybe contact me, connect with me. But also, what about carried interest on the federal level? You said you're going to
Yeah, that's always one of the first things that gets mentioned. There's been a lot of pushback. I mean, obviously, it's not been enacted yet. And by the way, the question was, what about carried interest, if you didn't hear it? This has been Sandra Levins, Sandra or what's Carl Levins. This has been his baby for the past 3 years. Has been trying to get this enacted. It was allegedly aimed at essentially hedge funds and private equity funds, but the bulk of the dollars, frankly, are going to come from real estate funds because, as most of you are aware, we've used profits interests in order to reward sweat equity in partnerships, and it's been one of the great things about dealing in partnerships. I don't know what to tell you. With last time we had a meeting of the partnership committee, the ABA tax section, just a month and a half ago. A couple of people on a panel said it's inevitable, it's coming in some form or other. Others disagreed. But if they're looking for revenues, that's a quick one. That's already been scored. It's frequently the way the legislation gets thrown together and they need to pay for this legislation, they need something that's going to raise $350 billion. Well, here's one right off the shelf, and that's how carried interest is likely to get slipped in there sometime, somehow. So I'm not, much as I am a proponent of profits interests and like to use them and don't want to see carried interest enacted, I'm not betting any money on this one not going through. Other questions? All right, well, thank you all very much for attending,
Thanks a lot.
and hope to see you again soon.